TCS trades flat after the company reports an inline set of earnings with the performance impacted by the new labour codes. Management tells CNBC-TV18 they will be more acquisitive going forward.
Meanwhile, HCL trades lower despite beating Q3 FY26 earnings estimates on all fronts, raises the lower end of the full-year growth outlook to more than 4%. The management tells CNBC-TV18 that they're looking at a good outcome next year based on bookings and pipeline, and are confident of 18 to 19% margins.
L&T under pressure today after reports suggest that Kuwait discusses cancellation of oil project tenders worth nearly $9 billion and is looking to rebid those tenders. Analysts say L&T was L1 in tenders worth over $4.5 billion.
Palu Forge is upbeat in today's trading session. The company clarifies that the IT rates is complete and no indiscriminating documents were found or seized during the operation. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as we speak, the markets as flat as can be recover from the lows of the day, but off the top as well. Well, Mangalam, first of all, wishing all our viewers a very happy Lohri. We are celebrating at home as well, so wishing all our viewers, Punjabi folk out there, a happy Lohri.
You want to say that in Punjabi, Nigel?
I'm not yet.
Lohri di lakh lakh vadaiyan.
Lovely.
But be that as it may, the markets recovered from the lows. It's that period of the year, where the entire country celebrates. Maybe Maharashtra will have Sankranti and all of those things. And the Nifty is recovered from the lows. And the next few days. And you'll have some happening in the southern part of the country, some happening in, various parts of the country. So it's a wonderful time of the year. And we also are looking at, this festive season celebrations extend into good results and thereafter maybe a blockbuster budget. That's what the expectation is. Let's see what the finance minister gives. Well,
that's right, Mangalam. Some kind of buying actually from lower levels. Look at Titan. That's clearly the stock in focus. They came out with a good quarterly update. The stock, I recall, had opened up in the red, but that's seen a sharp spike up. So I think we should get that one up for you on the screen. Titan's the stock that we're talking about. Good uptake is what we're seeing. Max Health actually has cut its losses out there. So I think we should get that stock as well. And the Nifty Bank, that's the beautiful looking chart. Well on its way back to around that 60,000 odd mark, holding above the 20 DMA. That's the important mark that you're looking at on the Nifty Bank. So the tech index may not fall that much from year on going by the results. Nothing really to cheer. Yep. But if it doesn't fall, well, that's going to be an index to track. It's moved into the green. And the Nifty Bank is holding in the green. But I think we've got our first management on the show. Firoz Aziz joins us to help us out with Anand Nathi's results. Remember, the stock is trading a little bit higher. The company's net inflows improving on a sequential basis. Let's discuss the quarter gone by and the way forward. I think now we have Firoz Aziz, who joins us on the show, the joint CEO at Anand Randi Wealth. Hi, Firoz. Good morning. Wishing you a cracker of a year in 2026. The end of 2025 as well was quite good. And I think over many, many quarters, consistency is something that the street has liked with regard to what you'll report at Anand Randi Wealth. A couple of details, though. Your AUM target has almost been met. I think it's time to revise it. Tell us what's the new guidance you want to give us.
Good morning, Nigel. Wish you and your viewers a great 2026. When it comes to our guidance of AUM, we will not change the AUM guidance. Of course, like you rightly pointed out, we said that we'll set out to achieve 1 lakh crores of assets under management in the Anand Randi definition of assets under management, not the industry definition, where we count only assets where we are currently earning on. There we are just 1,000 crores short, give or take. And I don't think we will revise it because March 31st could have whatever in store for us, because that's a 1 day's number. So we are trying to retain it for the moment because there's a lot of global uncertainty, and on 31st March, whatever is the reading will be captured. So we don't want to disappoint our shareholder by overcommitting.
Okay, you don't want to overcommit on, the AUM target because that's a lot of it is not under your control. It is market linked as well. But what about revenues and net profits? You've achieved nearly 75-80% of both your revenue and net profit target. You'll obviously, by the run rate that's going on, you'll obviously do 10% more than you've guided for. You don't want to up that guidance and still surprise the street positively?
Mangalam, we want to keep the guidance, like I said on the AUM front. You're absolutely right. If you look at 76% penetration into revenue, 78% penetration into the PAT target of 375 crores, we also had a debate, should we revise it? Then we said we are anyways going to do what we are supposed to and a little more, hopefully, with God's grace, if there is, in this quarter. So we didn't want to revise it. But we don't believe in overachieving substantively. And then because you have to bring in consistency, like Nigel began saying that we like to be consistent. So if I start with a big base, then I have 25% or 20 to 25%, which is my long-term guidance on the larger base. We don't like to degrow or even not grow below 20%. So if you see our last 17 quarters,
Yeah.
my worst quarter has been 23.7 year-on-year growth, and the best has been 41. That's also a wider range than we would have thought. So with reasonable probability, we will beat that guidance, but not revise the number yet.
All right, Feroz, you're a people's man. I've known you for many, many years. But as a boss, it'll be interesting to know how are the trends out there. Attrition, you normally boast about it being, I think, around zero or I think zilch. How has the employee behavior been? And, with this sort of competitive intensity in your industry as well, if an RM leaves, what about business? Will it get affected?
Nigel, this is an amazing question. Why? Because we are a people's business. If you see, our RM attrition was zero for 6 quarters, then it went up. But in our case, now let's assume last year, financial year, we had 3 people leave. So each of them have a story. It's not like a opportunity which takes people away. One person was having some mental health issues, so we had to let him go for his mental peace, and so on and so forth. There were some cultural issues where I let go of one, and the other guy was a friend of his. So that was my 3 people. Now coming to the more important question which you asked, we had about 446 crores of assets across these 3 people. If I look at how much assets did I lose from this 446, which is the right barometer, I still have close to about 346 crores out of that. So that's 20% assets under management lost of these 3 people whom I had to let go last year. So 80% or close to about 78% of that asset has been retained. Now, this year we have had about 4 to 6 people who have left us. And again, there is a story behind each case. I don't want to put those numbers out yet because the financial year needs to be over to see how much did I, as a company, retain.
All right. When we spoke about you being a people's man or this being a people's business, etc., the nice touch that you all had was, on your presentation, the second and the largest space was given to Chetan Shenoy, and, in loving memories and with deep respect as well. That speaks obviously about Chetan, the person that he was, but more importantly, the organization that you all are as well. So with that on board, let's just wrap this with a couple of things. You said that you always plan 5 years ahead, and you had a target of, RM, the AUM per RM going forward. The number was closer to 1,000 odd crores. Do you stand by that?
Yes, Mangalam, I stand by that. Like you rightly said, and the great part about TV18 anchors is they hold you accountable to what is said in the previous quarters, which I think is the beautiful way for us to also undercommit or speak with responsibility towards the larger shareholder. Now coming to the point which I made, that we plan 5 year ahead. So I actually plan September 2030. And I think that if I have to do 20% growth in September 2030, I'm just putting these numbers, please take it with a pinch of salt. I have to do 224 crores of revenue in September 2030 if I have to do 20% growth, and 289 crores if I have to do 25% growth. That's my boss's long-term guidance on the public domain. Are we planning it like that? We are planning it like that. Can you plan a wealth management business like that? To my mind, yes. If you don't have secrets with the regulator or with the client, that's the key. You don't have secrets with clients or the regulator, you can plan 5 years ahead. And that's a long strategy of how we do that. Most of our structured product business gets rolled in as well. So my trail business has to go up. If I project very modestly, I think I'll be able to please my boss, who's Mr. Raval.
All right. Take that point. Thank you so much, Firoz, for joining in. Wish you once again a cracker of a quarter, and we will have a conversation. We'll hold you accountable once again at the end of the fourth quarter as well. With that, we'll take a short break, come back. Don't go anywhere. Good conversation coming up with the management of Lemon Tree Hotels after the recent big developments that the company did, restructuring, value unlocking, and fundraising in Fleur Hotels. Stay tuned. Patanjali G. Keswani joins in. Well, the market continues to be volatile around the flat line. The Nifty is now marginally in red territory. It's led lower by a couple of these heavyweights. So we have, something like an L&T, which is lower. Alongside that, Reliance too has moved a little off the highs right now. Currently down by about 1.2%. But Lemon Tree is the big story of yesterday, this entire week. We had, Yash break the story where there had been, he had an insight or inkling into Warburg Pincus going ahead and investing in one of their important arms, that's Fleur Hotels, and that's exactly what the company announced. And to talk more about that, we have Patanjali Govind Keswani, who is joining in, the Chairman and Managing Director of Lemon Tree Hotels. Mr. Keswani, thank you so much for joining in. I remember this conversation we had 2 months ago. You said, Mangalam, wait for 2 months. It's going to be a very busy third quarter for me, not only from a business standpoint, but we are evaluating multiple things, pre-IPO, valuation, lock-in, maybe alternate structures for Fleur, and all those things. Turns out all those things have come now. So, congratulations on actually achieving all that you had guided for. But there are a lot of questions that we need to, understand as well. It's good that, Warburg is going ahead and buying APG's 41% stake in Fleur. The question is, at what stake, at what value, at what price?
So, good morning, Mangalam. The value is actually what is reported is the primary capital, which is 900 up to 960 crores. What they have bought that at is multiples of this 960. I don't, since it was a transaction between a buying and selling shareholder, I do not want to comment on it. You can ask APG or Warburg.
Got it.
But as I said, it was multiples of this 1,000 crores that they are putting in as primary into Fleur.
Got it. So this, Warburg looking to invest another 960 crores in Fleur as well. What would be the stake dilution for that? What's the timeline for this? You said it's going to be in multiple tranches.
Okay, so see, this is committed capital subject to opportunity. So the dilution will not be very significant. We will still be by far the largest shareholders, but let me put it this way. Fleur is going to list in 12 to 15 months, number one. So whatever money we take from Warburg, we will take in that period of time. This money will not come post-listing. In post-listing, as in when we need capital, we'll go to public markets, look at QIPs and so on. Now, coming back to pre-listing, which is next 12 to 15 months, Fleur itself has a free cash flow of a few hundred crores. So if you look at Warburg's 960 and Fleur and put it together, we would have equity available of about 1,700 crores. So, and if you add, overlay that with debt, so the total capital that could potentially be deployed in the next year or so would be about 3 to 3,500 crores, say about, $350 million. Obviously, now we will take money from Warburg only if it makes sense from a return perspective. So really, this is like a available capital. It is not capital that is being deployed in Fleur as till
No, Mr. Keswani, we get that point entirely. What the street basically just wants to know, it's understandable that, it's a transaction between Warburg and APG, and it's between two parties of which you aren't directly related. So it's not fair on you to comment on the valuations, etc. But what the street really wants to know is at what initial value has Fleur Hotels been sold? Because that is what will help them understand the overall valuation of the company then, right?
No, I don't agree with you there, Mangalam, because let me put it this way. There is always a buying and selling shareholder in a private company. and they could sometimes, the buyer could buy at a significant premium or at a significant discount. So let me just say it was not an unfair value from both sides, but I don't want to comment specifically on it. I think the more important thing is you can value Fleor quite clearly based on its current EBITDA, its likely EBITDA next year, which about 20 analysts have done. And if we are, and I think we have said quite clearly that we are building about 800 rooms, which is the Nehru Place Aurika, the Shillong Aurika, and the what is it called, Shimla Aurika. And we are in, very deep stages of discussion to acquire about 2,500 more rooms,
Right.
which is where this capital will come in. So if all this goes through, Fleor will be 1.5 to 2 times the size of which it would be as we are currently deciding or describing, which is 6,000 rooms. So it will be a very large company. It will have a very large EBITDA. I had said earlier that its EBITDA would be $100 million, once this demerger happens. But it will be obviously much larger than that. Now you have public market multiples, so just multiply it. It'll have very low debt. It will have a very large EBITDA. You have the multiples available. So anybody who's interested can do the math. It's very simple.
Hi, Mr. Keswani. First of all, congratulations on this deal. Making, it's quite an interesting deal. A lot of sell-side analysts as well will be waiting to quiz you a little bit more. But going by what you're telling us, 100 million of EBITDA, and if you give it a multiple of close to, say, around 20 times, very, very approximately, Fleor should be in the valuation of around 18 to 20,000 crores. Would that be a fair number?
I wouldn't, again, Nigel, good morning, but I can't really comment. I'll tell you why. So let me explain that. If you look at the asset companies in India, my best guess is they are basically trading between 15 to 25 1 year forward.
Got it.
On EBITDA, which means 4 to 6% yield. Now, this seems a small number, a very small yield. But why is it so? Because many of them have a very large growth pipeline. So really what you're buying at this multiple is not next year's EBITDA, but the EBITDA that it will generate with new projects over the next, say, 3 to 5 years. So in our case, if we are going to deploy a few thousand crores of capital in fresh acquisitions, fresh build-outs, and so on, whoever wants to buy our stock, which is why I'm being a little careful. I'm sorry, I don't want to give guidance. But what I'm saying is we own 41% of a company that will have 6,000 rooms and a very large pipeline and committed capital, which is a fairly significant amount. Now, you can do the math and you would know immediately what is the likely zone in which...
We did the math, and it turns out that you don't want to comment on that math or the direction of that math. But basis what you've said, that $100 million is the EBITDA that you would do, you would obviously want to do much more than that. So I'm multiplying that by about 25% more, and giving it a more conservative multiple of 12 times, it still comes up to around 13,500 to 14,000 crores in terms of value. But then again, I let you not comment on that because that may be giving a direction to the market. Having said that, you've spoken a lot about Fleor. What I want to understand is about Lemon Tree as well, because promoters' stake in Lemon Tree currently 22.28 stays. In Fleor actually goes down to 7.34%, and that will dilute even further with Warburg investing that 960 crores as and when the equity is required. Is this your way of cashing in on the Lemon Tree brand chips while leaving the business to the others? Just wanted to understand that.
No. So let me explain. How does this work out is that Lemon Tree shareholders are effectively getting 74% of the company. Warburg is only getting 26, as I think you are aware. So this 74% is remaining directly with shareholders at about 33%. Since I own about a quarter of Lemon Tree, I will get roughly, or as you said, 22.3% of this 33%, which is the 7%. So that is the shareholding I will get as a shareholder directly. So will all other shareholders of Lemon Tree who will get shares of Fleor in this demerger. Then 41% is the ownership of Lemon Tree in Fleor, which means all shareholders, me included, will indirectly own part of this 41% in Fleor. Am I clear on that? So Lemon Tree owns 41%. All the shareholders of Lemon Tree therefore have a indirect ownership of Fleur, and direct ownership is 33%.
Okay.
Now, what I do with that shareholding is obviously I have not thought about it, but it is going to be a fairly large sum of money.
Okay.
And maybe I will use it to increase my stake in Lemon Tree. Maybe I will leave it there. I haven't thought about it.
All right, so that discussion for another day, Mr. Keswani. But as you can see, we love our numbers, we love our holidays as well. But for the time being, we are going to force you to give us 3 numbers before we go. Debt, what will the debt look like, both in Lemon Tree as well as in Fleur? I think consolidated, it's around 1,600 crores ballpark. So how will that difference look like? And for FY27, what will the revenue look in both these two entities and margin outlook for both these two, debt and revenue and margins? Please go ahead.
So again, you're asking for guidance, so let me go back. Debt, we have, as you said, 1,600. 80% of that is with, or more than 80% is with Fleur. So when we do this demerger, all the debt will transfer to Fleur. So Fleur will be sitting on 1,600 less whatever debt we pay in the 12 to 15 months going forward. And that would be about 250 crores, I would guess, or 300. So really on a gross debt basis, Fleur would have a debt of about
13 to 14.
1,300 crores. Lemon Tree would be debt-free. Lemon Tree will have very significant cash flows from, direct cash flows from its third-party managed hotels, which, as you know, is accelerating now. We signed 5,000 rooms this year itself.
Yes.
And the fees it gets from Fleur, which is itself, say 150 crores. So put together, Lemon Tree would have fees of, I'm just making a guess, it would be 300 odd crores, and then accelerating rapidly in the next 3, 4, 5 years, both from the new hotels that we will open in Fleur, and of course from the hotels that we have signed, which will start opening again in the next few years. So this will be free cash flow, less corporate expenses and tax. There will be no depreciation. And what do we do with this money is the question.
All right, take that point. Thank you so much, sir, for joining in. Running out of time, but not out of questions. But we'll, revisit this as months progress to check the progress on this. At the same time, you can obviously guide us a lot better on the visibility as we come closer to time over the next 12 to 15 months. Sir, congratulations on this deal. We'll take your leave on that one. Take a short break, come back, focus on the markets and a lot more. Stay with us.
Welcome back. Well, the market's trading mildly in the red, actually more or less flattish. The good news is the breadth of the market is positive, with the number of stocks advancing more than the number of stocks declining. And the Nifty Bank, that's the solid one in there. That's holding on to those gains. We'll wrap up on this edition of Chartbusters. As we do that, a quick reminder, if you're thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026, is where that conversation begins. The alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in later this evening, 4:30 p.m. onwards, only on CNBC-TV18.